Nilesh Shah joins us now. Let's take our conversation forward. Nilesh, good morning. Always a pleasure to have you on ET Now. Thank you for joining us. From a patch of manic depression, concern, and now we are at a position where things are looking upbeat, things are looking strong. How would you assess the market? Do you think markets after the pandemic crash have normalized, or now markets genuinely based on earnings and valuations have run up ahead of themselves?
Market is forward looking. Data is coming of the past. If you look at September month data, it shows that despite medical situation, economic activity seems to be rising. And this is what market is factoring in. Now, number of cases have started coming down. Hopefully, the peak of this medical crisis is behind us. Normalization of economic activities have begun. And all the data which came out around manufacturing PMI, services PMI, GST collection, power consumption, e-way billing, they are all pointing towards growth, which is now going above previous year level. And this is what market is trying to factor in at today's valuation.
Right now, since markets always look forward, do you think when the actual numbers will come out, when companies will declare the quarterly numbers and when they will come out with the forward-looking commentary, it could be a case on buy on rumors and sell on news, because markets have already moved up in anticipation of a strong recovery?
Undoubtedly, in few cases that will happen where earning expectations of companies will be falling below the expectations of the market. However, we did see yesterday a large IT behemoth which showed not only above expectation sales growth, but it also showed expansion in margin due to restriction or cut in the travel and sales and marketing cost. So there could be earnings which will be ahead of market expectation and their share prices will rebound. There will be stocks where earnings will be below market expectations and they will definitely take a beating.
Nilesh, whether it is Reliance or TCS or HDFC Bank, big is becoming mega. That is the trend. So how will that translate into stock picking opportunity for mid and semi large cap stocks? Because mutual funds typically would like to buy good companies which are outside the comfort zone so that they can generate superior returns for their investors. But if the shape of the economy is migrating towards 3, 4, 5, 10, 12 companies, how will stock picking change for a mutual fund and for a mutual fund investor?
So if I just, Nikunj, try to break this question generically, today there are high valuations in defensive sectors like pharma, FMCG, to some extent IT. And then there is a fairly low valuations in many of the public sector enterprises, commodity companies, metal companies, real estate construction companies. In some sense, if normal economic activity does not resume and we continue to remain under pressure due to medical situation, then defensives will likely to do well despite their high valuation. But if the normal economic activity resumes and we are able to see better of medical situation, then the non-defensives will do well. I think events will shape which part of the market will do well. The same thing can be divided in growth versus value. Growth stocks have done extremely well in recent times, but they are now available at near lifetime high valuation. Value stocks are available at decade low valuations. Now again, if there is a catalyst, value will be unlocked and they will do well. In absence of catalyst, market will continue to veer towards growth stock. As a mutual fund manager, I don't have a choice but to maintain balance between defensives and non-defensives, between growth and value, and then play out with a hope that one of the theme will work out. Clearly, our alpha generation comes when stocks outside of benchmark indices does well, and we are long on those indices, on those stocks. Last 1.5, 2 years have been tough as Nifty has outperformed Nifty mid cap and Nifty mid cap has outperformed Nifty small cap. But this is the cycle. Eventually, good companies will do well. And as long as we have picked up good companies at reasonable prices, over a period of time, alpha generation will happen.
Sure. Nilesh, in terms of where we're kind of placed in the sort of unsettled global scenario right now, given that we're counting down to elections, keeping an eye on fund flows as well as India's attractiveness in the EM basket, where do you think we stand and how vulnerable do you think we are at this point to any of those upsets when it comes to overseas markets?
So one immediate concern is US election. To me, country's interest remains permanent. And my feeling is that US elections will have a temporary impact rather than a permanent impact. Obviously, if US market takes a heavy correction, then our markets may fall in sympathy, but that will be again short-term in nature. Eventually, our fundamentals will differentiate us. From a fund flow point of view, today India is in a better position. MSCI as well as FTSE both are increasing India's weightage over a period of time. There are many large companies which are looking to enter IPO market in India. This will also increase India's weightage. Many of these companies have very low promoter holding, hence their weightage in the index or benchmark indices will be very high. So my feeling is that from a flow point of view, we should be relatively better vis-a-vis foreign portfolio investors. The third is that the world has very high liquidity and very low interest rates. There will be money available for growth. And certainly in FY22, India will be one of the fastest growing economy in the world as FY21 base will be small. So put all the things together, will India get money in the world full of liquidity and low interest rates because of its growth potential? Answer is yes. Will India's weight in benchmark indices keep on going up, FTSE as well as MSCI, and hence it will attract more flows? Answer is yes.
Okay, fair enough. In terms of investor sentiment as well, back home, I mean, on one hand, we've got markets that are continuing to rise from strength to strength, as we can see in signs of that pickup, a faster than expected recovery coming in. Do you feel this will boost confidence further, or do you see more of an eye towards profit booking or continued cautiousness over the near term?
So the answer here is yes as well as no. At Kotak Mutual Fund, we ended up September month with a positive flow in our equity fund. However, I think mutual fund industry will yet end up with a negative flow. So somewhere it's a heterogeneous investor community. Some people are taking profit. Some people are redeeming because they are in financial need. Some people are redeeming because they are feeling direct investment is a better option. So there is a combination of factors which are influencing people to do what they are doing, and which is where at industry level we will probably see negative flows in equity fund even in September. However, at Kotak Mutual Fund, we have ended September with positive flows.
Nilesh, it's quite interesting what's happening in the diagnostics space, and Nikunj and I often chat about it. You can go on with the kind of moves that some of these stocks have seen. Thyrocare, for instance, a 37% surge coming in just the last, 2 trading sessions. How do you think this space is going to really expand? Or do you think the large share will continue to remain with the leaders, which is a very limited listing space for now, but a Dr. Lal and Thyrocare? Or do you think Apollo, with their pharmacy business and such, can also perhaps join into the bandwagon, and the space in itself can grow larger?
So I would not like to comment on a stock-specific thing, but let me just draw the contours between jewelry business and diagnostic business. If you remember earlier, we all had family jeweler, like we all go to mom and pop diagnostic companies. There were issues related to quality with family jeweler, issues related to choice, issues related to gold quality, and eventually large chains started emerging. They gained our confidence by giving us that keratometer, which was verifying gold quality. They brought professional designing. They got size and scale. And eventually jewelry business shifted from mom and pop jewelers to larger companies. And today we have seen emergence of many large companies. Some of them have done exceedingly well for shareholders. I think in diagnostic business, similar thing will happen. Today, we are going to mom and pop diagnostic chain. There are issues related to quality. There are issues related to efficiency. Now, branded diagnostic companies are emerging, which assures quality, which brings economies of scale. And slowly and steadily, business will shift from unorganized sector to organized sector. What happened in jewelry sector in terms of consolidation around brand, similar thing will happen in terms of consolidation around companies which can give quality assurance and which can deliver economies of scale or productivity efficiency. Any company which will be able to capture this trend will do well.
Yeah, rightly put, and a great analogy for our viewers out there to help better understand what could be the prospects and the dynamics that are playing out within diagnostics. Moving aside from diagnostics, Nilesh, what has really worked in the last 4 months at least is the entire rural recovery thing. But you think time now has come to actually bet on the urban trends? We were just looking at Tata Motors, for instance, and the kind of data points emerging from there, which now indicate that sales are picking up, or for that matter, even a Maruti. And this is just the auto sector that I'm talking about. But do you sense that tactically there is higher beta to be enjoyed and cherished if you were to bet on the urban recovery now?
On a logical basis, whatever you are saying is making sense. But I will rather now bet upon companies which are recovering on a global basis rather than just urban India basis. Today, there is huge opportunity for Indian companies to capture growth opportunities globally. World is looking China with suspicion. They'll be happy to buy goods from India if we can provide reliable quality and in volume. There are sectors like contract manufacturing, and yesterday we did see announcements by government for certain mobile companies and electronics companies. There are opportunities in chemical sector. There are opportunities in textiles and garments. So my feeling is that while urban recovery now should start getting its feet, especially with festival season round the corner, it will be important to keep your portfolio not only on just urban recovery, but also companies which are poised to do well globally.
Nilesh, at Kotak AMC, how are you approaching the banking space? And Perhaps let's spend a minute here, because every time we've spoken in the past, you've said that, look, we need to be with private banks. Now, the first wave of consolidation was when PSU banks lost share to private banks. Now, do you think the second wave of consolidation would be that the old guard, old private banks and the new age private banks, they will lose market share to the top 3 or top 4 banks? Because I was looking at the credit data from IndusInd Bank, which came yesterday, RBL Bank, which came last evening. All of them are indicating that their growth is not back, while HDFC Bank is growing at a large base. So how do you propose one should now really approach the banking space? Stick to the top 2-3 names, that's it, and in the beginning of the story?
Nikunj bhai, before I answer that, I just want to differentiate between fund-based activity and non-fund-based activity. So we believe within financial services space, there are opportunities in insurance, asset management, and incidental financial services like broking, where capital commitment is far less, return on equity is far higher, risks of NPA is far lower. And that remains our preferred segment within the financial services space. Coming specifically to banking services, clearly capital becomes a constraint from a banking growth point of view. And we think banks which are able to raise capital are able to pursue growth opportunity, whereas banks which are constrained on capital may not be able to pursue growth opportunity. Now the market has deviated towards top 4-5 names, and they are able to raise capital, whereas others are not able to raise capital. And this capital is becoming a big constraint for growth. The second thing is related to credit culture. Clearly, there are some banks which have gone towards higher return and higher risk lending. Some have gone towards more diversified lending, more lesser risky, lesser return kind of portfolios. Now, again, what kind of credit culture you develop within your organization, what kind of concentration risk you take, how do you manage the credit risk, that becomes extremely critical. So between capital and credit risk culture, you can figure out which are the banks you want to own.
Nilesh, in markets, a comment I remember you shared with our viewers, that focus on not where the puck has moved, but focus on where the puck will move. What do you think will be the relevance of an NTPC, an ONGC, PSU companies largely? Because markets, the way they are punishing them, it appears to me at least that markets have lost complete faith in PSUs.
Essentially, Nikunj bhai, this is because of the regular supply which emanates from divestment program. If you have a continuous seller without looking at price in the market, then it's very difficult for that stock to move till such time supply gets absorbed. Now, these companies have been seeing supply for decades without looking at the prices. And that has resulted into de-rating of the stocks. Within public sector units, we have seen if a company is given out on a strategic divestment basis, there is immediate re-rating. So if we pursue the path of strategic divestment compared to market divestment, can all the public sector undertakings get re-rated? Answer is yes. Will it benefit the principal shareholder, Government of India? Answer is yes. In absence of that, market is worried about the supply and hence keeping the prices low or derating the valuation. Moment you take out the supply fear, valuations will get re-rated.
Okay, we'll leave it there this morning, Nilesh. Good to hear from you, and a lot of focus continuing there on valuations currently. All right, thanks so much for joining us.